Hi, my name is Corbin. I'm the president and CEO of REMIC Wealth Institute. Over the next few weeks, we'll be shooting a DVD series of called "Recession is a Terrible Thing to Waste. Are You Mentally Prepared?" And if you're mentally prepared and you're financially prepared, you have to take advantage of all the opportunities that can be presented itself to you. You'll be listening to the news from the television, the radio, and reading different newsletter articles, and everybody's talking about all the negative things that's about to happen, that is happening in the recessionary. We're looking at it from a different perspective, an perspective from an investor's eye, a business owner eye. And what happens when things becomes problematic? Anywhere there's problems comes profit. And if you understand that simple term, you can be able to profit from all the different opportunities that can come available in this recessionary market. I'm here sitting with two of the best investors of the Greater Toronto area. I'm here with Colin Paponi from myinvestoragent.com, and I'm here with Sabine Alam from drpropertybuyer.com. Colin and Sabine are both real estate mentors and also investors. They invest for themselves and also mentor others on how to create a dynamic real estate portfolio. So Colin and Sabine, how are you doing today?
Oh, fantastic.
Fantastic.
Glad to be here, Frank. Thanks for having us.
Thank you guys for coming by. Now, my question is, there's lots of dooms and glooms and ups and downs and negative stuff going on in the market. Mm-hmm. And they're claiming we go into a recession. Some claim the recession is over, and everybody's claiming different things. My question is, how do we prepare ourselves? I'll start off with Colin. How do we prepare ourselves as an investor to deal with all these ups and downs in the market?
Well, I think as an investor, we have to stay true to our strategy and our approach with real estate. Regardless of the market is up or down, our strategy should maintain and be the same. And what our strategy is to invest in cash flow producing properties. The recession is going to give us opportunity, even greater opportunity, to buy a lower price. But if we stay true to that consistent approach, our opportunity for profits is even more so. In great markets, people used to invest on appreciation, and sometimes that bites you in the butt, as we've all noticed, hoping that we make 10%, 20% in a certain period of time. If we stick to the fundamentals and invest in good markets with cash flow producing properties, we're going to be ahead 90% of the time.
Excellent. And Sabine, how are you preparing yourself in this recessionary market or in the market in general to stabilize or increase your portfolio?
Okay, so first of all, it really shouldn't matter the recession or not. I think the most important thing is, you hear so many different things, so many different news aspects, and you kind of wonder, is it coming, is it not coming, how should I prepare myself? I think you should be in a position all the time to make good choices, financial choices, and align yourself with opportunities. And that's what a good investor does, is you align yourself with all the right opportunities out there. You need to be connected, you need to know what locations you're interested in, where you're interested in, how those neighborhoods in those areas that you're interested are looking in times of recession or not. These are the times when, for example, if you own a home right now, and you're looking into owning a better property, a more expensive property, and a time of boom, you were not able to do that, this may be the perfect time. Having said that, you do realize that you may be losing money on your own property, when you're trying to sell, but if you're okay to take a little bit of a hit and go for a bigger achievement, that's a great thing. This time is a great time. And I'll give you an example. For example, if you own a home for $100,000, and I'm going to just play with simple numbers here.
Yeah, absolutely.
So $100,000 home, and you wanted to move into a $400,000 home, and you were not able to afford it at that time. And the recession comes, and when you're going to sell the home, you're going to sell it for say $20,000 less, but that $400,000 home now all of a sudden is more affordable to you. Now it's maybe $360,000 or $350,000. Or even $300,000.
So you're saying that you sell your personal home for a little bit less, but you're also buying the bigger investment property, the bigger property for a lot less, percentage-wise.
Exactly. Okay. So if you're able to take a little bit of a hit for a greater good, you're in a good position. And always remember, it's going to turn around. This is a bubble. If it's going to go up, it's going to come down, and vice versa.
So what I'm understanding from both of you is that if your strategy is right or your strategy is perfected, just stick to your strategy. So don't let the recession scare you. Don't let it give you a situation to pause or withheld in your investment approach. So continue to invest whether what's going on in the market. Stay consistent. Colin's talked about getting positive cash flow. So constantly analyzing your property for positive cash flow and stick to this strategy. And that's very good. That's what we tell most of the students at REMIC Wealth Institute and most people that deal with us from an investment perspective, is that if your strategy is right, you stay true and continue to invest. Now, what are some key factors, and this is what are some key factors that you look for in a local neighborhood or community when you decide to invest?
Well, the key factors that you would look for is the demographics. You're going to look at the population. What's the growth there? The upcoming things that may be happening around that area. What's the general idea of that location? Are they immigrants? Are they, how much of an income are they making? So those are very key factors, because you want to see how much of an investment you're going to put into that property or into that area in order to get how much you're going to make. So you have to have a very solid plan. And I always say it can't be based on speculation. It has to be calculated. It has to be, we're taking calculated risks. It's always a risk.
Right.
Okay, business is always a risk, but you're making calculated risks. We don't do real estate on assumptions.
Right.
Yeah.
Excellent. And that's a stable market approach. Would you change that for the recession?
Not necessarily. I would still look into those demographics anyway. As I said, recession or not recession, I think you should be looking into those things anyway. You may tweak your options a little bit. So, for example, you may be working with the sellers much more closely in those times of recession, because they would be in a position where they may have over leverage. There's no equity in the home. They're having a hard time selling. They don't have enough money to pay the agents. There could be many problems that they could be facing in those times. They may be lost a job, spousal problems, but then that could be in any way. However, in recession, it only comes up even more. So you want to work a little more closely and tightly with the sellers, and you want to give them more options, and that's where the REMIC strategies or creative strategies for investments, property investments, comes in.
Excellent. And I'm Colin. So as this recessionary market turn, what are some of the opportunities you see out there from an investor's perspective that you can leverage and take advantage of?
Well, we're seeing a little bit of more motivation on the selling side. So, you're able to negotiate, and as Sabina pointed out, use some creative measures to create a win-win situation for both the sellers and buyers. I like to look at areas. I like to promote investing for the long term. I believe real estate is not a get-rich-quick scheme, it's a get-rich-slow scheme. And one of the advantages of investing in real estate over stocks is we have more control over our investment. When we invest in stocks, we're hoping that the management or the CEOs are doing a good job. Whereas when we invest in real estate, we have control over what's done, where we're going to put money, why we're going to invest in certain areas. So I like to invest in areas that are up and coming. I like to follow the trend. If the government is putting millions of dollars in improving a waterfront, if the government's creating jobs in a certain area, if the government's promoting public transportation, I like to follow the trend and kind of piggyback off of the big boys, so to speak.
Right. I like that. You talk about, Colin, when the government is committed to investing in your market, and you tend to piggyback that and follow that. Now, what are some of the programs, or the government programs that you see in here, and I assume you talk about the Greater Toronto area, that you see the government is investing and they committed to, that you would be able to leverage?
Well, Toronto, as we know it, is exploding. We just been awarded condo capital of North America.
Wow.
There is a great incentive to buy. Just today, I was reading Forbes magazine. Canada's now moved up from 4 to number 1 in the best places to do business. We are number 4, now we are number 1. So there's a lot of incentive for people looking to Canada, and Toronto is, in my opinion, the greatest city in Toronto, in Canada. And what they're doing on a more specific scale is they're investing in the waterfront, they're investing in public transportation, they're investing in the infrastructure. and it's as simple as just doing your research, working with someone who's educated in that, and leveraging that.
It's a very lucrative area for international investors too. If you can tap into those international investors, this is a great place, because they're looking for places where they can invest and get their bang on the buck. So they're looking for those stuff. So if you have the opportunity to target the international market, do so. This is the great time.
Right. So again, what we've seen is a lot of international investors. They're coming into Toronto. They're investing here. Again, that's driving more growth to this local market. So some of the key factors that we look at when we invest in real estate is pretty simple. We look for employment, make sure that people are employed. Number two, what's driving that employment? It normally comes from diversity or diversify industries, from banking, manufacturing, construction, healthcare, nursing, you name it. So if a person loses their job in one market, they can move on to something else and still pay their rent or pay their mortgage. Those are some of the key factors that we look for. And we look for also growth, human growth, or immigration growth, or reproductive growth, people making more kids, or more people coming to your local city. And that's what we look for. Right now, we see a tremendous diversify employment, tremendous growth, tremendous employment in the Greater Toronto area. And that's why that's our number one city to invest in Canada. And for the United States, New York City fits the same description. And the international market, London, England, fits the same description. So what we predicted in the recessionary market, these three key cities would have robust and able to sustain any increase or decrease in the market. And that's why we consistently advise most people to invest in these three cities. We'll be right back with a recession is a terrible thing to waste. Are you mentally prepared? Thank you.